Ryan is standing in his driveway holding a check for $8,400. Best month he's ever had as a landlord. 400 feet away, his twin brother Colin hasn't logged into his brokerage app in 4 months. He genuinely forgot his password. 20 years from now, one of these brothers ends up with more money than the other, but it's not the one you're picturing right now. And there's one specific decision made quietly around year 12, taking about 90 seconds, that ends up deciding the entire outcome. Neither brother realizes it's the most important choice either of them will make. I'm going to show you exactly what that decision is, what it's worth in real dollars, and by the end, you'll know which brother you actually are. Ryan and Colin are 32. Their grandfather passed and left each of them $60,000. Same amount, same day, same blank slate. Ryan puts 20% down on a $280,000 duplex outside Columbus, Ohio. Colin dumps his into a Vanguard S&P 500 index fund, sets up an automatic transfer of $350 a month, and doesn't touch it again. Ryan's mortgage runs 6.8%, payments $1,460 a month. He rents both units for $1,150 each, $2,300 coming in against $1,460 going out. On paper, that's $840 a month in profit. Ryan does this math in his head roughly 9 times a day for 3 weeks straight. Colin tells people at Thanksgiving he's in index funds. The conversation moves on within 4 seconds. Year 1, Ryan feels unstoppable. 2 sets of keys, a spreadsheet he's proud of, a story that makes him interesting at parties. Colin's $60,000 has become $64,000. Nobody asks Colin a single follow-up question. Then year 2 happens to Ryan. 1 unit sits empty for 7 weeks between tenants, $2,650 in lost rent, plus $800 to clean and repaint. A furnace dies in February, because furnaces only die in February, and that's $4,100 he didn't budget for. When Ryan finally subtracts every real dollar that left his account, his true profit for the year is $1,900 on a $60,000 investment. Colin's account has quietly become $71,000. He did that by doing nothing. Here's the number almost nobody puts in these videos, and it's the one that actually matters. Landlords typically underestimate their true annual maintenance costs by 40 to 60% in their first 5 years of ownership. Ryan isn't bad at this. Ryan is completely average. That's what average costs. By year 5, Ryan is a different person. A tenant stops paying for 2 months before he starts eviction paperwork. 6 more weeks lost, plus $900 in legal fees just to get his own property back. He's replaced a water heater. He's patched a roof he already dreads replacing. His true cash-on-cash return, 4%, not the number he described at Thanksgiving 2 years ago. Colin crosses $118,000, 0 hours spent. Also, notably, nothing he can point to from his car. Now, here's where most of these comparison videos quietly stop being honest. At year 7, Ryan's duplex, bought at $280,000, is worth roughly $325,000. His mortgage balance has dropped to $228,000. That puts his equity near $97,000, built from a $60,000 down payment. That's the one thing real estate does that nothing else replicates. He's growing the bank's money too. Every dollar the property appreciates, he keeps the full gain, even on the 80% he never owned outright. Colin doesn't get that multiplier. He put in $1, he owns $1's worth of stock. Nothing more ever. So by year 10, and this will surprise you, they're almost dead even. Ryan's equity, around $135,000. Colin's portfolio, around $141,000. One of them got there sweating through a February furnace repair. The other got there watching Netflix. So which one are you? That's the actual question this video is asking, not which investment wins on a spreadsheet. At year 10, they're separated by $6,000. The real question is whether you're someone who absorbs a $4,100 surprise bill without it wrecking your month, who doesn't mind a Saturday loss to a roof, or whether you'd rather never think about it and let the market work while you live your life. Neither answer is wrong. Most people pick pick based on which one sounds better at dinner, and that is the worst possible reason to put $60,000 anywhere. I'll be honest with you, I've rebuilt this exact model probably 36 times for people convinced real estate is the only real way to build wealth, and I used to be one of them. I bought my first property at 29, sure it would outperform everything. It didn't, not for years. What changed my mind wasn't a better spreadsheet. It was realizing I'd never once asked myself whether I actually wanted to be the guy a tenant calls at 11 p.m. I didn't. That answer mattered more than any interest rate. Now, remember that decision I mentioned at the very beginning. Here it is. At year 12, Colin does something that takes him 90 seconds. He logs in, bumps his monthly contribution from $350 to $550, and closes the tab. That's it. No debt, no toilet fixed, no risk added. By year 20, here's where they land. Ryan's duplex is worth close to $500,000. Mortgage paid off, plus roughly $95,000 in net cash flow collected above every expense over 2 decades. Total wealth, around $595,000. Colin's portfolio, because of that 90-second decision at year 12, has grown to nearly $530,000. Without it, he tops out around $410,000. That one decision is worth over $100,000, and it cost him nothing but 90 seconds and a slightly smaller grocery budget. Ryan still edges ahead because leverage on an appreciating asset held 2 decades is genuinely hard to beat. But the gap that looked enormous at the start of this video is now the width of a single decision either brother could have made in an afternoon. Ryan got his $8,400 check that morning because he answered his phone every time it rang for 8 years. Colin got his number because he set something up once, forgot his password, and remembered to increase one line item 12 years later. Both are real strategies. Both are real people doing real work, just build in completely different currencies. If this actually helped you figure out which brother you are, hit like. It takes a second, and it's the only way this reaches other people asking themselves the same question. And subscribe if you want more breakdowns like this one run all the way through with nothing left out.